Welcome to the first annual Zevin Advisors China rankings. I will be discussing sort of what has gone down over the course of the last year, as hopefully many of you have already seen. We sent out the actual rankings and the report this morning, and I'm very excited to be able to share with you our findings and sort of our outlook. And as I mentioned, I think on a couple of occasions in LinkedIn posts or through our emails, we'll be having a probably 20 to 25-minute presentation. And then that will be followed by whatever questions the audience might have on any China-related subject. We've already had some clients send through some questions in advance. But for what we're going to do right now is I'm going to bring on to the stage my colleague, Harry, who is the architect of this rankings every year. And he is going to run through the top line findings, after which we're going to be answering questions. What I would stress to everybody who is here attending is any questions that you might have, go over to the Q&A tab, type them out, send them through. I'll write them down, and once we get done with the formal side of the presentation, we'll start working through those questions. So with that in mind, let me bring Harry onto the stage. And Harry, I'll pass it over to you to run through the rankings.
Thank you very much. So just before we get into the top 25 themselves and the findings, I just wanted to highlight a few key points from our method and the model that we use to come up with these rankings. So the first one is the overall structure. So we base it off of the three main business lines that we look at. So the first one is mainland. That's basically investing Chinese money in China. Then you have outbound, which is investing Chinese money globally. And then you have inbound, which is investing global money in China. Now, we weigh each of these different parts differently based on our expectations for how each of those opportunity sets is going to develop. So based on that, we have the mainland as the largest portion, making up 50% of the model, inbound 30%, and then outbound 20%. Then within these main sections, we do have many subsections based on each of the different specific businesses. So things like fund management, private funds, QDLP, things like that. And each of those have their own weighting, which is dynamic based on how that business line has developed throughout the year. So obviously I've been doing this for 5 years now. So there's been pretty significant changes in how those businesses have stacked up over time. So if you think back to 2019, it was just the first kind of phase of market opening. After the move to 51%, we were starting to see some competitive reaction, whereas now we're seeing 100%, we're seeing quota-less inbound access, we're seeing a restart of outbound quota. So you can see how kind of over the years, those subsections, the weighting kind of fluctuate with each of the different business kind of outlooks. The second point I'd like to make would be about the data that we use. So we use, the vast majority of it comes from public sources, and it goes beyond just pure scale. Like, it's not just AUM. It goes into other operational aspects, and these come from things like regulatory findings, fund filings, manager filings, industry level data. And then to supplement that, for the areas of the business that do have less complete data sets, and maybe they're more on the private side, for example, the institutional business, privately offered funds business, we do send out a manager questionnaire which supplements the public data that we have. But like I say, the vast majority of the data that goes into our model is from public sources. Another issue just based off of that data is that we do have a cutoff of December 31st, 2022 for this year's rankings, which is obviously a bit contentious this year, just given everything that's kind of happened in the first quarter with some of the approvals that came in. But we do think it's quite important just to keep that hard deadline, just given that most of the data that we do input into the model is as of year end. So it kind of keeps it consistent across the data. And then obviously there is going to be a rankings next year, so it's not like the things that happen in the first quarter aren't going to be included at all. But we do think it's kind of important to keep a black and white deadline as of year end to keep it all consistent. Then the final thing I'll just mention is the scoring system that we use. So it is a relative scoring system. So that basically means that the leading firm in each subsection will get the maximum score, and then all of the other firms are scored based off of that. So that means that if the leading firm gets better, then other firm scores can go down, and it gives kind of a good sense of how things are changing year over year. So just off of that, if we go look at the top 25. So just a few things to highlight. I won't go through every name, but as Peter mentioned, if you do have any questions about specific firms, I'll be happy to try and answer those. But yeah, you can see here, like we do have a bit of a grouping starting at the top with the top 5. And obviously JP Morgan pulling away as the leader as well. But one thing I would like to highlight is that if you look at the firms from kind of 6 down to 15 even, some of those firms there are putting the pieces in place to really pose a challenge to those top 5. So you look at the likes of Morgan Stanley, which had its approval after our cutoff. HSBC is kind of building out this more multi-piece wealth management architecture using all of its insurance and bank and everything entities. So there's definitely companies in there that will challenge this top 5 in the coming years. It's just as of now, those 5 are the ones that have kind of gotten those pieces in place up to now. Another point I'd just like to highlight on the top 25 is just right at the other end. So Nomura was the one that came in at the expense of Value Partners this year, but it could easily have been any one of 5 or 6 firms. Like there's a kind of a grouping again between like 25 and even 35 of firms that are very closely ranked. So there are firms there again pushing to get into the top 25. It's getting even more competitive, as it has done every year since I've been doing this, to kind of make your way into the top 25. And I think that's also shown by the score for the 25th ranked firm, which is higher this year than it was last year by quite a way. So if we just go on to the next slide, I won't kind of focus on these drivers too much, but I just characterized last year as basically it was a year of 2 parts, and you can talk about it as pre and post party congress. The first half of the year, maybe even the first 3 quarters, were just lockdown essentially. Like I think this time last year we were all confined to our apartments. Some people unfortunately were confined to their offices. And that obviously that environment wasn't conducive for a lot of business activity. It was more about continuity than expansion. Then in the third quarter, it was kind of all eyes were on the party congress. It was just making sure nothing blows up before that comes. And then, yeah, the fourth quarter, it was just an explosion of activity. Like there was a sense before the party congress that something big was happening and there were going to be big developments coming after. But I think the pace and the size of some of the development caught even us by surprise. So like the pension rollout was within, I think, 2 weeks of the end of the party congress. You had approvals for the likes of BNP Paribas, ABC Wealth Management, Fidelity, Neuberger, Manulife, all of these. It was just a relentless kind of week after week after week development that carried forward into this year as well. And we expect that to keep going as things keep rolling forward, as sentiment kind of improves a bit. But yeah, that's kind of how the year ended and how we carried forward into 2023. So if we just look at now, we'll go into the 3 different business lines. So we'll start with the mainland business, which, as I said, is running Chinese money in China. I think one key development I just want to highlight here first is the acquisition that Manulife closed. So obviously it's a big thing for Manulife themselves in that they now have whole ownership of a 60 billion renminbi fund manager. It has a QD license to run the outbound business. It's just recently been granted access to the third pillar pension scheme. I think it's also a good, a big kind of development for the industry more broadly, in that it shows that these buyouts are in fact possible, because up until that point there were kind of some more questions starting to rise. Like you had Morgan Stanley and JP Morgan had been in the pipeline for years. And there was some other firms that had initially talked about buying out their partner that then had shifted to take a more greenfield approach. So then this acquisition kind of just does solidify that the buyer opportunity is there. And then we think that's kind of going to shape some of the ways that firms view the buy versus build and the market entry opportunity moving forward. If we look onto the outbound side, so I guess this is the part that was the least action-packed, should I say, last year, in that a lot of the year was quota tight because of the RMB depreciation. But that said, there was some development. There was a little bit of QD quota, and some of that went to the foreign banks, which is obviously good for asset managers that utilize the bank QD channel in white labeling their products. There was also pretty sizable growth for some QDLP managers, which we can say that's the first time that channel has actually reached some level of scale. You now have several managers running over 1 billion renminbi, which in the grand scheme of things is still small, but compared to the 50 million that it used to be, like it's still considerable growth. And that kind of, we put that down to a distribution, an ease of distribution, should I say, in that the foreign firms are finding it easier to work with the private banks that are running the QDLP scheme, namely Ping An Bank, China Merchants Bank, than they do through, let's say, the MRF scheme, where they have to use their onshore representative, which doesn't necessarily have the incentive to sell the products alongside their own mutual fund product. The last section I would highlight would be the inbound section. Obviously, we can't talk about inbound without talking about uninvestable. So it started as a very narrow discussion around a certain subset of Chinese equities, namely the offshore listed tech companies, but it kind of morphed into this all-encompassing China catch-all phrase. But if you actually look at the flows that were occurring last year, there were still inflows pretty much month on month into onshore Chinese equities. And that kind of played out in the competitive landscape as well. Like if you look at the top 10, so JP Morgan overtook BlackRock for the first time. BlackRock has long been the leader in inbound. And that's essentially down to the strong A-share, the strong active A-share franchise that JP Morgan has. And just with that, I'll highlight a bit of our method for the inbound side. So as well as pure scale, which we do clearly consider, we also look into it a bit more deeply in terms of onshore investing funds versus more Greater China offshore investing funds, in that we weight the onshore investing funds a little bit higher. And then we also look at fee extraction. So clear active funds generate more free revenue than passive funds. So therefore, that's kind of just gives a sense of how JP Morgan was able to overtake BlackRock despite still being fairly significantly smaller than it in an overall sense. And then just one other competitive development I wanted to highlight on this page was Hang Seng taking over the SSGA tracker fund. When we discussed this internally, kind of the topic point was serendipity, in that how did the US-China tensions end up with Hang Seng becoming the second largest Greater China fund manager in the industry, and that it took over this fund, which is the largest, still the largest single fund, and now that's propelled Hang Seng, as you can see here, into the top 10 for our inbound rankings and into the top 5 by AUM. So that was just an interesting development I thought I would highlight here too. I'm going to pass over to Peter now, and he'll give us a rundown of kind of the trends that we expect to see in the year ahead.
Appreciate that rundown, Harry. I would just highlight, I guess, a couple things as my screen loads. There we go. Two things. Number one is the concept of what 2022 actually was. When we got into January, and just to give you a bit of context, going through our own internal sort of, annual review process at the staff level, I really just took a step back and realized if you survived 2022 regarding a China business, you succeeded. It was sort of that contentious. and extremely pleased and super proud of everybody here in the office for everything that we were able to do. But things that I think need to be recognized. We were talking about J.P. Morgan or BlackRock or others that have operations here on the ground. These organizations literally had their staff in the offices for the better part of 60 plus days. We could call it a closed bubble if you want, but essentially, the requirement was you need to keep operating, and to do so, you needed to be in the office. And then I would say that over the course of the period, and I think this ties in quite properly with what I've got laid out here on the slide, what exactly transpired throughout the second half of 2022? How did that impact, I would say, broadly speaking, sentiment? Harry did a great job of talking about the whole concept of uninvestable. And what may or may not that mean as we head into 2023, both in terms of the opportunity that China actually represents, the competitive landscape, where things are heading, so on and so forth. Just quickly before I go, I see that a few of you have already sent in questions. I will get to those. If anybody else has any additional questions, feel free to type them in, and I promise you, whatever you ask, I will address. Number one, in terms of what the year ahead is going to look like, there's a couple themes that I think are undeniable. They've played out already in the first 3 months of this year. And if anything, they will, at a bare minimum, they will be maintained throughout the course of this year and quite possibly become even more heated. Number one is this whole concept of uninvestable. To give you a quick anecdote, just this morning we were going over some information, and one of the key and most important messages that I've been talking with clients over the course of the last 6 to 12 months is, wherever humanly possible, ignore the headlines. And what I mean by ignore the headlines is it's been all China all the time, and it hasn't been positive, as I'm sure many of you that are watching will know. The fact remains, though, is what you're seeing, even to this very moment, are nothing more than what I call hot takes. The real, I think, important aspect is to focus on action. What exactly are the policies coming out? What exactly are you and or your competitors actually doing? And I think most fundamental to that exercise is, what is the flow of funds? And to the point that I was making about this morning, Stock Connect and Bond Connect, we get regular updates on whether you have net inflows or outflows in those programs. And while it hasn't been a straight line up and to the right, it is very clear to us that there continues to be demand by global investors, however those may be defined, for exposure to renminbi asset classes. And I will always make the distinction between China asset classes and renminbi asset classes. And it's quite clear to us that we are seeing, again, irrespective of headline, that investors are still looking at China and are making an allocation. So that's, I think, the most important element right now when you look at those headlines. At the same time, though, one of the interesting points that's raised here is something we just call bifurcation. Now, this has been a very clear trend over the course of the last year, and again, a trend I expect this year. And what we mean by bifurcation are, you basically have two groups of competitors that are presently looking at the China market as a growth opportunity. On the one hand, you have those organizations which have committed, demonstrated a commitment, communicated a commitment to the China market for quite some time, and they continue to do so. These are the firms, as I've mentioned, that represent those organizations that are in the upper tier of our ranking. Now, one of the bigger differences that I've witnessed over the last year is quite simply that those organizations, whenever you get a license or a new product or whatever the case might be, They're taking a very low key, if you will, approach to global publicity. You'll certainly have publicity and meetings and local headlines here in China, but you're not seeing the same degree of grand announcements in the Financial Times or the Journal or Bloomberg or wherever else, which is understandable. I mean, we can talk about flows and we can talk about, the opportunity of China, but at least for the present moment, it is an environment that can be a little bit challenging for senior executives. And I do not envy anybody in that position that has to go through and navigate the terrain of trying to do what's right for the business, while at the same time trying to sort of fend off, if you will, message management. So that's one side, if you will, of the equation. The other side of the bifurcation are firms that have dabbled, if you will, at the margins of China, but never really made a big commitment. And if I can be as blunt as I typically am, these would predominantly be American organizations. These were firms that we saw get quite excited towards the latter half of 2020 when China was opening. COVID was looking not as serious, at least here in China. And quite frankly, at that time, when I was having conversations, my advice was just to wait. Firms we found were trying to rush in. We're 180 degrees away from that. These very same organizations are deprioritizing or putting on the back burner or whatever the case might be. But there's an additional wrinkle that I think is important to note. And that is, it's not just about deprioritizing the market. What I think you're going to probably find, or there will be headlines, somebody asked a question actually about this, is these organizations, especially those with the investment management WFOEs, will most likely begin to start pulling out. Now, why is this the case? Well, I don't think any of you on the call are going to be overly surprised when I say this, but back in 2017 and 2018, when the investment WFOE became quite popular, these organizations, many of them rushed in. I want to say there are 50 plus investment WFOEs, not all registered as private funds or QDLP, but there are many of them that entered the market with expectations of being able to start slow and build a business. And with very few exceptions, nobody did so, especially amongst those with private funds. And we're at a point right now where these organizations have essentially, already they've gone through all of their working capital. And when you go through your working capital, you're in a position where you now need to go back to headquarters and you need to ask for more capital. It's a very difficult environment, I believe, when you're looking at where things are. And trying to convince organizations, whether they're in London or Boston, Chicago, New York, where have you, it's probably going to be the easier decision to simply just exit and pull out. We've only seen a couple do so. Again, I'm referring to the investment WFOE at the moment, but I think you'll find more as well. So with that in mind, let me just move on and get down to this page where I will begin to answer your questions as I see them coming through. Unsurprisingly, one of the very first questions that came through was asking, why is Vanguard withdrawing from the China market and what might it signal? Now, I'm not sure how many of you have been following me on social media or our clients, but we still remain, and I know this is an opinion that most do not carry, but we've not seen any formal announcement by anybody at Vanguard indicating that they are exiting. Now, everybody from the FT, Reuters, Bloomberg, I think everybody has come out and said that they are exiting. I've been contacted by some of these reporters saying to me, but Peter, we know that they've gone to CSRC and stated their intentions. That very well may be the case. I'm not here saying they're not exiting. Many of you may actually remember that back when Vanguard entered China, we were quite open in terms of our skepticism that the Vanguard model would actually work within the China market. And I cannot tell you how many vocal opponents to that opinion there were at the time. But my point is I don't know if they're leaving. I've not seen anything formal. We as an organization, we only operate in the realm of whatever is in the public domain. That is what we comment on. Nothing against the media, but working off of uncorroborated quotes or anything else in terms of insiders or what have you, I just don't think it's helpful. But that aside, the Vanguard model, even though they were with Ant, while it may have made sense, would have been a difficult business model to really pursue. So if they are to exit, again, it wouldn't be a major surprise, but I think it really highlights the point that I was making earlier, which is going and targeting the China market requires, in my opinion, two fundamental factors. The first one is that you need to have a genuine long-term commitment, and I know that's a cliche to say that with regard to China, but you need to have a genuine commitment to the China market that goes beyond your organization, meaning that when you go to a board or a management committee or a capital committee, and you're looking for an investment to build in China, it has to be beyond the careers of the people making that decision. And for quite obvious reasons, that normally isn't the case. There is still this desire to have a 3 to 5 year break even on operations, J-curve growth. As much as China has done a phenomenal job marketing itself as the world's second largest economy, which of course it is, China remains an emerging market. And as an emerging market comes with all associated risks of any emerging market. So I think number one is having that commitment to a genuine long-term plan. The second and most critical strategic factor is that you need to be able to have a team on the ground that has what we refer to as both the responsibility as well as the authority to execute what is required with minimal, I'm not going to say no, but with minimal, shall we say, interference or what have you from headquarters. The team that's on the ground has been hired and is capable and should be allowed to go and run that business. Unfortunately, we see very few examples where that is actually the case. It's not to say that Vanguard didn't do that or others. I'm not privy to their internal operations, but I can share with you that in more conversations than I can even recall, there is a genuine and continue to grow frustration amongst the senior management teams here in China for these global groups that they want to be able to deliver, but need to be able to do so without the constraints of headquarters bearing down on everything from marketing or product development or a host of other factors. So that is one question. Oh, I need to get my glasses back on again. Let me see what else we can have. Okay, I'll get Harry to talk about the rankings in a second. Harry, I'm not sure if you can look at the questions, but there's one about how the rankings have changed in the context of local competition. We can come back to that one. Okay, bank wealth management. Peter, what are your thoughts on bank wealth management? Bank wealth management is a factor in the rankings. But this is an interesting question because it ties in to my previous points, talking about, understanding the market, providing authority and responsibility, so on and so forth. I think at the moment there are 4, maybe 5 of these bank wealth management joint ventures. We, and I should say me personally, have been very suspect of the outlook for these joint ventures for multiple reasons. Number one, I've been here long enough where I found it a little too coincidental that the moment China moved in favor of 100% ownership of fund management, that all of a sudden these bank joint venture, wealth management joint ventures became quite popular. Everybody was talking to all of the various banks. But more importantly, first and foremost, 55% or 50% or 50.1 or whatever the case might be, that is not control. And this is not even about China. This is about joint ventures anywhere. To have effective control these days, you need at least 80%. Now, you can craft your, call it articles of association or your various documents to try to find a way to actually have operational control. But for the most part, simply saying I have more equity than you does not constitute control. That would be number one. Number two, bank wealth management is not wealth management as most of us, or I should say, those who operate globally understand. Wealth management in China, very simply put, is genuinely just short duration yield enhancement product that is meant to be relatively low risk, but to provide some degree of enhanced yield over a bank deposit. So when we see organizations that look to use bank wealth management for things like quant or offshore or equity or other types of solutions and products, is it possible? Well, of course. And there are organizations that have done those types of products. But when you look at what it is that the end investor is looking for, the investor doesn't go to a bank wealth management business looking to get into an equity product or an offshore product. They'll go to a fund manager typically for those types of investment solutions. A local investor in China goes to a bank wealth manager, again, for short duration, highly liquid, yield enhancement types of products. So my outlook right now is not rosy. I'd love to be proven wrong, but we will have to wait and see. Harry, let me bring you up again and have you go and talk about how the rankings have sort of changed in the context of local competitors.
Okay.
It's just loading. There you go.
Okay, so I think the challenge with talking about the context of local competitors is that the China business remains very siloed, in that the institutions you have in, say, the fund management market are different from the institutions you have in the private fund market, or different from the institutions in the bank wealth management market. So I guess to take it in the context of local competitors, you'd probably have to look at it on a business line by business line kind of approach. So I guess with the fund management side first, like the joint ventures have been there for 20 years. There's some of them in the top 10 by AUM. So on that side, you can say the foreign involvement has been probably the deepest of all of the onshore financial services business. But then if you look at things like the private fund business, the kind of success of foreign firms has been a bit much more sporadic, and as Peter mentioned earlier, like there's even the chance that some firms may look to exit, but that's not to say there hasn't been any success at all. So if you look at the likes of Bridgewater, which although we can only see their AUM band, officially it already ranks among the largest firms in the industry, and that's why it's the only so-called hedge fund that makes our top 25. Bank wealth management, obviously Peter's just touched on, it all comes down to more business plan and how the foreign firms are going to address that versus how the local firms have done it forever. And then on the cross-border business lines, the way the foreign firms approach it and the way the domestic firms approach it are pretty different, just especially for outbound based on access. So obviously fund management companies have the QD license so they can do their own thing, whereas at the moment, the only kind of foreign majority firm that has any QD quota is BlackRock, CCB, and now obviously Manulife as well. So I think it's hard to compare in the context with local competitors across the whole picture, just given how siloed the different aspects are. But you can definitely have more of a tell when you look at each of the different business lines independently.
Thanks, Harry. Okay, I've got a great question that I can sort of use to sort of swing things around. So someone's asked about, we all know that Fidelity went off with their first product. I think they finished formal fundraising on Friday, and we were hoping to see maybe the sort of the gongao that would come out today to show us what AUM was raised and what have you. And this question is tied in as well, asking what is our view on operating a wholly owned fund management company versus a JV. So let me answer that second question about the difference between wholly owned versus JV first, and then use Fidelity as a good example. First and foremost, the structure and the platform needs to match with what it is that an individual organization is looking to achieve over a very long period of time. So it's not just a joint venture or a wholly foreign owned. You can look at things like maybe you're an insurance company, let's say. I'll use Allianz as a good example. Allianz set up they bought out their JV on the insurance side. They have a asset management platform underneath that. Theoretically, they could then wait 3 years and they could, launch a retail mutual fund under that asset management platform. Now, they're doing something differently. I realize that. But, the point being is that there are multiple avenues that can be taken, both wholly owned and as a joint venture. I mean, technically, if you look at, I believe it was a week or so back, Warburg Pincus, a private equity group of all, they just got approved for a second minority share ownership in Zhongou Jijing. And, this is clearly what is right for them. They have is it still called Huabao Xingye? I think so. The old Fortune SocGen, or they have a stake in that. So you can take multiple routes. And some groups, I think, have looked at this strategically. I think the majority, unfortunately, may have not. And it's still a little bit more of well, we have a good idea, let's run with it, and then we'll try to fix it later, which is never ideal. So then when you look at a group like Fidelity, look, Fidelity's been around for a long time. They've been in China for a long time. They're going forward with an equity product for their first product, which we think is, it's great. Maybe not the best market, but how do you plan and go through that process? What I think is going to be fascinating to watch, and this firm's not alone, is Fidelity was very fortunate, in my humble opinion, to have been able to bring in one of the best operators in all of the industry, Helen Huang, coincidentally, who was over at Huabao Xingye. And she is, in my opinion, like I said, one of the best operators. But the question is, and I don't have an answer, but my question is, will she be given the necessary latitude and authority, as I keep coming back to do her job the way that she feels that it needs to be done? Or will Fidelity, call it error on the side of corporate, meaning, well, this is how we do things. And I think one of the interesting sort of points on this is, Peter, we do things in Seoul, in Tokyo, Taipei, Hong Kong, Singapore. This is how we do things. Okay. But here, there are very clear, but very different rules of engagement. And it's a very open, competitive framework. There's no surprises, but it's very different. And I think in a lot of examples that I've had conversations with organizations, very unnerving sometimes with what is required by the foreign groups if they want to enter the market. So in terms of Fidelity, we'll have to wait and see. Hopefully the numbers will come out tomorrow. We don't necessarily cast judgment on any organization, especially a new company, based off of one product. It's really about the determination. We could look at something like BlackRock as an example. They entered the market first, good for them. And it must have been a very difficult year for Tom Xiaodong and his team. Because, as soon as they came out, you had COVID lockdowns here and you're trying to run the company and launch product and grow. It's not easy. So we'll have to wait and see on the Fidelity front. But this ties into another question that came through, asking about how many foreign fund managers do we think the CSRC will approve in the next 3 to 5 years? It's actually somewhat of the wrong question to ask. It's not how many the CSRC will approve, how many are actually going to apply? I think right now, the only application that is relatively new would be Allianz Global Investors. They submitted their application a month or so back. There's talk about UBS. I mean, it's been all over the press. UBS, again, they've got an interesting strategic sort of trilemma to work through between UBS SDIC, ICBC Credit Suisse, and then their supposed application for 100% owned. Again, that's a strategic choice that the organization will make based upon what's best for their long-term vision. But beyond that, I can share with you that the regulators are quite keen to see more organizations enter and apply. But it goes back to my comment about sentiment, uninvestable, the headlines. It's an environment right now where there's career risk all over. There's career risk if you look to do something in China. There's career risk if you're in China, and it's quite, I would say, frustrating for me, and I find it to be quite unfortunate, because now is probably one of the better times to really look at what is possible and really move forward. But I would say in the next 3 to 5 years, if there were 10 global groups that applied, I would say that's probably on the aggressive side. Now, who knows? I have this, I've taken this away from others that I've heard, but this whole concept of recency bias. Everybody's looking in the rearview mirror from what happened 3 months ago, and they seem to be making choices and decisions regarding China based off of that. It's quite possible that by the time we get to the second half of the year, conditions and whatnot will have improved dramatically, far more clarity, a more risk-on environment. Who knows what the drivers might be, but you could just as easily see global groups start, clamoring in and starting to put together applications and whatnot. So we'll have to wait and see. Let's see here. Another question I can answer probably quickly. How many years do you think foreign fund managers will need to turn to profitability? It's either going to be 3 years or 8. And I don't mean that jokingly, because of the volatility that typically exists within the market. If we have, for whatever reason, a more subdued, choppy market, as we've had over the last couple of years, notwithstanding COVID, clearly, it'll be a challenge. Look, there's 160 fund managers. Everybody's launching product all the time. You need to have a track record. There's a host of things that you need to do in the very beginning to build that foundation that is required, after which you can then move more quickly at building scale. But there is a degree of markets involved. And if there were to be a significant risk-on event for whatever reason, equity markets were able to go off. I forget who it is. It might be China Merchants, but there are tactics like taking a well-performing fund manager and bringing them out, launching a new equity fund, raising 10 billion in a day, if you will. So it depends on the approaches that are taken, but the foundation and the performance we feel is super important. But markets themselves will be a big driver between whether it's a 3-year process or an 8-year process. And then, you might have some in between. Let me see what else we've got here. Let's see here. A lot of Vanguard questions. Why is Vanguard withdrawing from the China market? I think we answered that one. Can you share more? What is Vanguard's model? I don't know. What I can tell you is the Vanguard model is to really strip it down. They don't pay for distribution. That's their DNA, and it's worked very, very successfully for them over the last 30, 40 years. But when Vanguard entered the market, call it 2016, 2017, thereabouts, we simply looked around and said, well, Singapore, Hong Kong, Taiwan, what I would refer to as like ethnically Han Chinese investor bases. They're not committed, if you will. They don't necessarily agree with the whole save for the long term, dollar cost averaging into low fee passive funds. I won't bore you with more detail on it, but other than Australia, Vanguard struggled and effectively pulled out of these other markets. And I think they tried working with Ant to see if there was a way to do it with a partner, and maybe they will ultimately pull out. It's unfortunate. We want to see more players here to try to learn and adapt how they can in the marketplace. Let's see here. Is now the right time for global firms to invest more on their China business given current macroeconomic? So the let me address the elephant in the room. Look, geopolitics, and again, the ultimate elephant in the room, cross-strait ties, is nothing new. For those of you who don't know me, I arrived here in very early 1996. And keep in mind, back then there was no internet. But what I think was critical was we found out at the time that there was what is now referred to as the third Taiwan crisis going on. Lee Teng-hui was, getting elected as president for the first time, and Jiang Zemin was doing what Chinese presidents will do, and making their points clear on how they thought of this. This is nothing new. The difference is, in 1996, nobody cared about China. It wasn't on the front of all the newspapers. I would even argue, based upon the conditions over the course of the last 6 or 7 months, that what we're seeing right now is nowhere near as aggressive, if I can use that word, in terms of the Chinese, their reaction to what's going on. I'm more shocked at how the American political classes are taking a very different point of view in their actions. I'm concerned, to be quite frank, but at the same time, I've seen all of this time and time again. I was here when the Americans and the Chinese accidentally got in an air collision and an American spy plane crashed in Hainan Island, or when the Americans accidentally bombed the Chinese embassy in Belgrade on Mother's Day. These sorts of things, and I'm not trying to downplay them, this is geopolitical risk. But the real issue when it comes to this sort of risk is to genuinely ask yourself, am I, as a business, being compensated for taking on that risk? And I find it quite fascinating, actually more than fascinating, that if you look at the business that we all are in, it's the business of exactly that. I mean, asset management, fund management, essentially are individuals that run portfolios where They're assuming risk every day with the expectation that the risks they're taking are being compensated for. That's the return. That does not seem to take place in the business world when it comes to China. It is risk, risk, risk. And there's a ton of risk. I'm not here to tell anybody there's not. But ultimately, you have to ask whether the risk is being compensated for. And I believe it is. I mean, I've invested more than half of my life in the market. But certain organizations do not. So we'll have to wait and see. Again, I go back to recency bias. I go back to all politics is local. I think the Americans are acting in a certain way because it plays well back home. But it's a challenge. There's no doubt about it. But it is a challenge that is not going away. You know, I'm sure there are many people in America and Europe, for that matter, that wish they could, you know, just wish that China were no longer the second largest economy and, you know, the major global trading partner of the majority of the world and so on and so forth. It's not going to happen. Trying to find a constructive way to have a dialogue that is respectful to all parties. And again, I'm not picking sides. I'm just trying to state the obvious, which I don't think is where things are at this point in time. Rant over. Now, let me get off my soapbox. With UBS taking over Credit Suisse, do you see a significant change in the market landscape among foreign firms in China? I don't know exactly what UBS and Credit Suisse sort of coming together has to do with the landscape. The short answer is I don't. The landscape is pretty open. I think that there are enormous opportunities for the foreign community to enter. The local fund industry has operated for 25 years. And if you look at the names that are at the top of the league tables from, you know, Yifangda, Jiashi, Borsche, all of them, I would argue that they have become a little bit more relaxed. Wouldn't say lazy, but there's a degree of perhaps hubris. And I think that there are ample areas the foreign firms can come in and exploit. It is not, in my opinion, an overly difficult market in which to operate and compete, so long as you are able to adapt to the local rules of engagement. Could you please comment on money market fund developments, please, and also the new launches, AAA, 7-day NCD funds? What I would talk about with regard to money market funds is, and I find it fascinating, is, you know, these are the go-to asset class, if I can call it that, where investors are increasingly more and more comfortable parking their idle savings. It used to be the bank wealth management products, but now that the majority of those products have gone what we call on platform and now trade at a NAV, no longer principally protected. There was an event last November, a credit crunch of sorts. And what we discovered was those wealth management products do not always trade at 1. They can fall below. They can go above, but they can also fall below, which we found to be a very eye-opening experience to many investors, to which we then learned that, you know, a portion of bank wealth management assets were reallocated into money market funds. In terms of the new launches for AAA 7-day NCDs, I will be upfront. Not sure about the details on that. If you'd like to email us and ask us, you can see, I think Oliver's email address is on there. More than happy to follow up with you afterwards. On the ranking methodology, are mainland, outbound, and inbound business equally weighted, or are they weighted by AUM? Just quickly, just mindful of time, we weight them 30%, or sorry, 50% overall of all of the various variables, factors. 50% is mainland because that is where we consider to be the most growth, the most profitability, basically the biggest opportunity. The inbound, Harry, correct me if I'm wrong, is 30%, correct?
Yeah.
Okay, he's giving you the thumbs up. And then the outbound, which is the QDLP, QDII, and the like, that's 20%, predominantly along with institutional mandates, I might add. simply one of the primary reasons, it's the most competitive. Everybody wants to be able to sell their scaled product into China. And at the same time, the fees aren't really the best. So in terms of the weighting, that's how we do things. But there's a host of variables and factors that underlie each of those that have their own sort of sub-weighting. Let's call it our special sauce. There's a certain degree that we'll share, but we don't want to get into too much of the detail. We feel very confident, though, considering it is our 8th year doing this. We do make slight changes over time. We feel if you look at the names on the list, and I'm sure there are those out there that will disagree, but I think if you're being honest and you look intuitively at the rankings, it makes intuitive sense. Wow, there's a lot of questions. Any lessons learned or particular observations from recent product fundraising for WOFE FMCs, or have there been missteps? There's not really, I would say, any lessons that can be learned, primarily because it's very early, but also 2022 was such a unique year. It's difficult to make comparisons for a new wholly foreign-owned fund manager against sort of trends in the past. As we say, the jury is still out. What I think is interesting is if you look, we can only really go to BlackRock because they've been around for the longest. Is, you got to give them kudos because they have been pretty aggressive with their product launch strategy so far. I want to say they're on their 6th or maybe even 7th product. And again, the local market is one in which you have, or you are kind of required to be pretty aggressive in terms of rolling out new product on a pretty consistent basis. There's a lot of degradation of AUM from pre-existing products. This has been a constant issue within the industry for, from the very first day that Hua An launched their first open-ended product. I believe Neuberger's done the same thing. They've just started out with their 2nd product. Fidelity, even before they finished their first fundraising, announced that they were launching another product. So it's difficult at this stage to make any credible comments. I don't think it's fair to the teams. We watch things pretty closely, but not necessarily any lessons. I think the struggle would be, and I don't have an answer for this, or I don't have clarity into the subject, but I would hope that the investment teams that are on the ground locally are given complete discretion over how the products are invested at the asset level, industry level, and individual firm and security level. I have concerns that there may be internal protocols from headquarters in terms of how portfolios can be constructed. Are there limits on turnover? We all know that portfolio turnover can be quite high here. Don't have at the moment clear indications on whether that is or is not the case. But if headquarters or any internal part of the organization is providing guidance in terms of how these portfolios should be run to the local investment teams, that would be, I think, detrimental to the portfolio performance and the attribution over time. Let's see here. Can you elaborate on local rules of engagement? Okay, it's already 9 o'clock. I think this was, and I know there were other questions, everybody, and maybe at a later time, I can continue to do these types of, live streams, ask me anything, whatever the case might be. But I think this is a perfect question to sort of end the live stream on. And that is, China's been operating its fund management industry for 25 years now, which by itself is frightening to me. And over that time, new rules, new regulations, there's been mistakes along the way. They've all come out and they've all really been amended and adapted and improved upon. But, there are certain simple things, and I'll share with you a couple of points to really highlight what I'm sort of referring to. And many of you on the live stream here might think that what I'm sharing with you is, of course, obvious, but in reality to the global community, it's not only not obvious, it's also in many examples quite frightening. Number one, the CHOP, the foreign legal person. This is something that absolutely frightens the daylights out of foreign companies. Like, what do you mean that there's somebody who has a giant piece of red plastic that can chop on any contract and the firm is responsible for that? Yes, that is how China works. There are ways in which you can provide internal controls that allow, however, for that risk, as the foreign firms look at it, to be mitigated. It doesn't have to be all or nothing. So there are ways where you have to consider, okay, and this is one of the most basic ones. I think over the course of the last, I don't know, year or two, the one that made me laugh the most was the capital commitment letter. Now, multiple conversations with these foreign firms where organizations that were looking to consider doing a fund management business were required to sign a letter that essentially said, if you enter and if you run into problems with your capital and your finances, that the parent is going to provide whatever capital is necessary to maintain the operations of that business. Well, first, the foreign firms went absolutely insane and thought, well, that's unlimited liability. Why would we ever agree to this? So on and so forth. And I had to essentially talk them off the cliff, if you will, by saying, number one, the regulators aren't saying that if you feel the need to exit, that you can't exit. Of course, if you reach a point where capital is an issue and you decide to exit, you can exit. What the regulators through the capital commitment are trying to make clear is that if you do exit, do not even think about returning to the market. And then I've had to turn to these both clients and non-clients and say to them, this is actually your fault. And as you probably can imagine, they were all up in arms. What do you mean this is my fault, our fault? And I said, look, go back to the 80s and the 90s. How many times did organizations enter Hong Kong or Singapore and then exit, and then enter again, and then exit because the markets were volatile? What the capital commitment letter is really meant to do is to weed out those organizations that are genuinely committed to the market long term. So you have those bigger issues that need to be addressed. And then on top of that, I was talking about responsibility and authority, talking about, how do you go through and hire the right people? I'm shocked, quite frankly, at something very simple. A client will say to me, Peter, we're looking to build a business in China, and I need to find someone to be the general manager, and they have to speak English. I said, why do they have to speak English? It's China. And I said, by demanding that they speak English, you have reduced the quality candidate pool by 95%. There are so many amazing individuals out there that don't speak English. And there are solutions to the issue of, I need to be able to communicate with the general manager. I keep pulling at these different threads, and for me, they seem very obvious, and I'm continuously, and I shouldn't be, continuously shocked at how, after 20 years, these issues continue to come up. I mean, I'll finish on this one personal point. Literally 21 years ago, something like that, I was running as a project manager, setting up one of the first joint venture fund management companies, Guangda Baodaxing. And back then there was 6 or 7 of us trying to set up a joint venture. We all thought we knew what we were doing. In hindsight, we didn't have a clue. The whole industry was new, let alone JVs. It was a mess. We made our mistakes, we moved on, and we learned. Fast forward to 2017 and 2018, when all of these investment woofies were being introduced, and I was having conversations with people who were making the exact same mistakes that myself and others at the time were making in setting up a business. And I would communicate to these individuals, look, work with me, don't work with me, talk to somebody. There's a tremendous amount of value and knowledge that's out there. You do not need to make the mistakes that others made. And yet, what happened? With very, very few exceptions, you had avoidable, costly mistakes made at just about every turn. And again, I think that's kind of where the industry is right now. I mean, I will give kudos to JP Morgan, BlackRock, Invesco, UBS, Schroders. These are companies that have, without question, demonstrated their long-term commitment. Many others are moving in that direction as well. All I would probably share at this last time, and I'll go through your questions later and see if I can find out if I didn't answer them. Please email them to us. More than happy to find a way to chat with you after this. But I think what I just wanted to end here right now is to say thank you. To say thank you to Harry for working on this. This is his last hurrah. He's off to go do some travel, and he's moving on in his professional life. But you know, just to say to all of you, look, reach out if we can do anything, if you have any questions. And I will do, and we as a firm will continue to do everything we can to try and educate the global community on what they need to do. And I look very forward to, at a minimum, doing this live stream again next year. But I guess, and I'm pretty confident, that we'll probably be doing one far sooner than that. So again, thank you all very much for joining us tonight, this morning, this afternoon, wherever you are. And again, email me any questions I didn't get to, and thank you very much. Have a great day, evening, and morning.